Competition is for losers. This is the thesis that co-founder of PayPal and Palantir and Facebook's first angel investor, Peter Thiel, expressed in a lecture in Stanford in 2014. Similar to Peter Thiel's thesis, my thesis for this video is not a moral or social one, but rather, it is one on practicality and economics. If you were to ask a typical economist what are the best ways a developing country can grow its economy, you would probably get an answer like just invest in infrastructure, invest in education, open up trade, and foreign investments. However, if it was that easy, why aren't there more developing countries growing out of their poverty? What metric could we even use to measure the return on investments on these policies? Of course, these steps are fundamental in promoting economic development, and it is clear all economies that have prospered out of poverty have all done this in the past. However, this is all too simple. I am here today to convince you that the best way to rapidly modernize an economy is to follow Peter Thiel's philosophy. Competition is for losers. What I mean is government-sponsored monopolies are essential in rapidly growing an economy. We can see this in many examples in recently developed economies. China has monopolies like Huawei and Tencent. South Korea has giants like Samsung, LG, and Hyundai. Taiwan has TSMC. Japan has Sony, Toyota, Honda, and Nintendo. And even Saudi Arabia, a previously very unlikely contender for economic global superpower, now has Saudi Aramco, the second largest company by market capitalization in the world, and the only non-US company in the top 10. As you can see from my examples, what I mean by government-sponsored monopolies are not socialist state companies, but rather market monopolies with a clear profit motive that the government handle with preferential treatment. The idea is that the government offer exclusive rights or aggressive incentives to one or a few key select companies, that these companies become the domestic and even global monopolies of their respective sectors, but are not immune from market forces. Investing in developing countries is already extremely risky. For the risk, there needs to be a substantially proportional reward to make the investment worthwhile to an investor. However, a company in an impoverished country is in such a disadvantage within the global economy that the government would have to sponsor or offer preferential treatment to even make sense for a foreign investor to even consider investing their own hard-earned dollar. Also in a developing country, the government can create artificial stability in the economy by selecting few key players as the main industry leaders and reduce the number of uncertain variables by only dealing with those few. To then foster economic growth, as firms in weak private sector countries won't have strong negotiating power, the government can coordinate and negotiate immensely lucrative deals on behalf of the chosen firm, as was done for Huawei in China, TSMC in Taiwan, and POSCO in Korea. More on these will be discussed in more detail later in the video. In addition to government involvement to foster investor confidence, monopolies itself have massive advantages, such as economies of scale and vast cash pools necessary for long-term R&D innovation, which is usually the primary way to make economic profit rather than normal profit. With exclusive rights licenses or government contracts, the monopoly could also have a guaranteed income from its home country that other global competitors might lack. This concept of monopolies fueling unparalleled economic growth is not a new one. During the US fastest growing period, which is considered the 1870s and the 1880s, where the output of wheat increased by 256%, corn by 222%, and coal by 888%, and miles of railway tracks by 567%, the US was riddled with powerful corrupt monopolies such as Standard Oil with John D. Rockefeller, US Steel with Andrew Carnegie and J.P. Morgan, General Electric with J.P. Morgan again, and railway industry with Cornelius Vanderbilt. This period is called the Gilded Age and had an economic growth that was unheard of in world history and helped prop up the US as the global superpower it is today. During this time, corruption was also in an all-time high, where bribery for preferential treatment of these robber baron monopolies was considered just part of business. Even the first company ever to be sold on the public stock market and the first ever capitalist organization was a government-sponsored monopoly called the Dutch East India Company. The chartered company, established in 1602 by the government of Netherlands, was granted exclusive rights within the country to carry out trades in Asia. The Dutch East India Company, or its abbreviated Dutch name VOC, paid an 18% annual dividend for 200 years and brought unfathomable wealth to the city of Amsterdam, making it the first financial hub of the world. If you have ever walked down the streets of Amsterdam, it is hard to miss the effects that the VOC had to the wealth and architecture of the city. Everything we have discussed here is too simple. To get a deep analysis on government-sponsored monopolies and their role in economic growth, we can study the case of how both South Korea and Taiwan evolved from a resource-limited, extremely impoverished countries on the brink of collapse to the global economic superpower that the world depends on now. To begin with, South Korea was a small, war-torn country that desperately survived the Korean War. With an estimated 85% of all buildings in the peninsula destroyed and the people traumatized from chemical weapon attacks, the Korean people had limited resources to work with. Only about 30% of the land in South Korea is cultivable, making the country rank lowest in arable land per farm household. In 1962, South Korea, or also referred as Korea, had a per capita income of just $87, which was lower than per capita income of Haiti, Ethiopia, and Yemen, and even about 40% below India's at the time. The US per capita income, as comparison, was about $3,300 in 1962. Taiwan was also under a similar condition when the Republic of China government arrived after the Japanese occupation. Being a part of the Pacific Theater in World War II, Taiwan was a war-torn backwater island. Due to the destruction, railway and roads and harbors were operating at half capacity. By 1945, the coal production had fallen to only 37% of its peak production level, fertilizer production to 32%, and steel production at 17% of peak production levels. With a relatively low GDP per capita of $160 in 1950, Taiwan was fighting off hyperinflation with June 1949 wholesale price index increasing 5,599 times since the 1945 figure. Coming back to Korea, the trauma from the Korean War and the complete lack of domestic resources gave the Korean people a sense of hurry to find or produce exportable goods to trade. When finding an economic model to follow, the Korean government took inspiration from the lessons learned from the previous Japanese colonial occupation. Similar to modern Korea, Japan has gone through a huge modernization process during the Meiji Restoration, with a few key corporations to spearhead the movement, such as the Mitsubishi Group or the Sumitomo Group. Of course, to do this, there were problems with slow-moving bureaucracies that could blatantly distort the efficiency in resource use, which naturally comes with government intervention in the economy. However, in the early years of Korea's development, it was just easier to get the bureaucracy moving rather than to bring the weak private sector to life, as there were not much private sector to begin with. The first decisive action that the government of Korea took was to establish the Pohang Steel Mill Company, now known as POSCO. To ensure that Korea has an industry to build more complex industries on, the government of Korea in 1968, led by the military dictator Park Chung-hee, worked with the Japanese government to fund Pohang Steel and coordinate the technical assistance with already established companies such as Nippon Steel. By 1981, the total steel capacity in Korea covered 90% of the domestic market and looked towards export expansion. Now in today's global economy, POSCO has become the dominant player in steel industry as the world's largest steel manufacturing company by market value. After establishing large steel mills, the Park-led government targeted other sectors that could potentially serve as steel-consuming sectors, such as shipbuilding, automotive, infrastructure, and electronics industries. Park especially wished to build companies that could export their products overseas. The government established the Strategic Export Industry Policy, where once the government has decided to promote a certain strategic industry, all forms of preferential incentives were provided to them, such as tax exemptions, faster depreciation of equipments, loans, deductions for import of capital goods and intermediate goods, arrangement of licensing technologies, and differential pricing. Heavy differential treatment were enforced based on export performance. If a manufacturing firm earned more than 50% of its revenue in foreign exchange, they were allowed to write off an extra 30% of depreciation. With the policy, large pools of foreign capital were provided to key exporting companies with tax rebates on materials imported for export production, subsidized interest rate loans for export industries, foreign currency loans to finance export on long-term credit, and export insurance. The Korean government at the time coordinated large foreign investment loans that individual companies would not be able to negotiate for itself and agreed to subsidize and guarantee loans to attract more dollar into the list of pre-approved Korean companies. Similar to Korea, Taiwan was focused on export industries. First, to protect Taiwan's fragile emerging industries, Taiwan imposed tariffs and import restrictions on specific industries to ensure existing Taiwanese companies can grow without competition. The Taiwanese government then set its eyes on growing a Silicon Valley-like tech hub within the country. To do so, in 1981, the government created the Hsinchu Science-Based Industry Park, a specifically zoned area devoted to foster scientific and technological development. Once established, the government deliberately convinced hand-picked top Taiwanese engineers who were working overseas to come back to the country and build new companies within the industrial park. One of the engineers appointed to join was Morris Chang to start a semiconductor firm called TSMC. The Taiwanese government acted as a venture capitalist for these companies from then on, as the individual companies were too small and too unknown to ask for any substantial loans or investments, while the government could. The government were the major investors for most of these companies. The government would, even in a controversial move, sometimes order private individuals to invest in these companies, such as when the government ordered Wang Yongqing, the Formosa Plastics businessman, to purchase 5% of TSMC's shares. To get TSMC and Morris Chang up to speed on the latest semiconductor technology, the government coordinated technology giant Philips to come to Taiwan to provide TSMC with intellectual property and knowledge transfers and technical assistance on the 1.5 micron process, which became TSMC's core business. In exchange, Philips received 27.5% of TSMC's corporate shares for a below-market price. These type of technology transfer agreements were frequently coordinated by the Taiwanese government, such as with RCA a couple of years back, again for TSMC, as the government was the only organization large and powerful enough to negotiate these deals on behalf of the weaker private sector companies. To also foster the semiconductor market within the country, many of the industry's corporate taxes were either slashed or eliminated to encourage long-term research and development projects, reducing the semiconductor industry's income tax to only 1.5% by the 1990s. These types of purposeful fostering of industries were working. Before Taiwan's company building exercises, most of the economy depended on agricultural production. With the Taiwanese government's heavy hand into the industrial sector, Taiwan's heavy chemical and technology-intensive industries, which was less than 10% of total manufacturing output, grew to 60% in 1986. And even to 75% by 1995. Back in Korea, government-subsidized loans became so ubiquitous that in the late 1970s, it was typical to find large firms having liabilities 5 to 10 times as much as their net worth. The outstanding external debt quickly rose to $37 billion in 1982, from a mere $4 billion 10 years before in 1972. These rapid increases in foreign investment into the country was only possible from the government's involvement, coordination, and sponsorship of these debt programs. Korean companies during that time were viewed as too unstable by the global market for any investor to directly invest in. To carry out its revitalization policies, the government simply relied on existing, reliable, and most importantly, hand-picked companies. These larger hand-picked companies were more efficient from their economies of scale and also had access to broader ranges of foreign markets. In addition, during the foreign ventures, to prevent large foreign companies' leverage in negotiating tables, having government hand-picked established companies helped balance the power dynamic. A key example of a hand-picked company could be seen with Samsung, a company we usually associate with smartphones and semiconductors today. First started out as just a groceries and food trading company, shipping noodles and fish to China and within Korea. The company would later expand into sugar refinery and woolen mills. However, with Park's government support, Samsung completely transformed into the vast conglomerate it is today. When the government announced shipbuilding subsidies, Samsung was the first in line to grab the free incentives to become the top 10 global shipbuilder. With the government aggressive financing and support into Samsung Heavy Industries and other similar companies such as Hyundai Heavy Industries and Daewoo Shipbuilding, Korea has been consistently maintaining half of the shipbuilding market share. As you might have guessed, Hyundai was later handpicked for the automotive manufacturing industry, and Samsung was for electronics and semiconductors. These handpicked conglomerates are now known as chaebols, as these family-run businesses skyrocketed to be the economic titans of the country. This idea of chaebol is not a new concept. In fact, in the paper I used for a large portion of my research from the Kellogg Institute in the University of Notre Dame, which was written in 1991, also referred to these economic units as chaebols. Across the East China Sea, Taiwan's company building was becoming successful. The firm started in Hsinchu Industrial Park under the Taiwanese government's orders, bloomed to account for 10% of the Taiwan's GDP by 2007. With only around 100,000 to 150,000 people working within the park during that time, that was less than 1% of the population, powering 10% of the country's entire economy. The government's choice to purposely agglomerate the companies within the space and negotiate technology transfers and investment deals on behalf of the companies worked to a great success in building a stronger knowledge base for the economy to build on. TSMC, the government's shining star, now in the modern day contributes a whopping 15% of the country's GDP and owns 60% of the global semiconductor market share. USMC, another Taiwanese company founded in the Hsinchu Industrial Park, has another 8% of the market share. Another 20% is owned by the one and only Samsung. Back in Korea, with hand-picked chaebols tasked to revitalize the country, between 1973 to 1978, the annual rate of growth in value add contributed by the largest 10 conglomerates was as high as 30% each year. In 1973, the largest 10 conglomerates' share to the country's GDP accounted for 14%. This figure rose to a whopping 23.4% by just 1978. And now Samsung, one company alone, accounts for 20% of Korea's entire GDP. To put this into perspective, Apple, the world's largest company, only contributes 0.5% to the US GDP. Even Nokia, at its peak in 2000, only contributed 4% to the small Finnish GDP, while holding a respectable 41% of the mobile phone market. In 1961, Korea's export grew from a just mere 4% of the country's GDP to half the country's GDP by 2016, one of the highest rates globally. Over the same period of time, the average income rose from just $87 per year to an outstanding $27,000 per year by 2016. And now the country's GDP per capita is a tremendously respectable $35,000 per year, a figure that is higher than countries such as Spain, Italy, and Portugal. In a country where usable buildings became a rare sight, to the home nation of companies that are leaders of cutting-edge technologies and could not only fight in a global market, but also dominate, chaebols became the proud product of a small nation trying to make a name for itself. Now, of course, other government policies in both South Korea and Taiwan contributed to its economic growth. Taiwan had its 10, 12, and 14 major construction projects and extended their compulsory education from 6 years to 9 years in the 1970s. Korea similarly spent as high as 76% of their total public sector spending on infrastructure in the 1970s as well. However, it is also undeniable that both countries' entry into the global market and their domination in the global market was suited to their respective governments' monopoly building initiatives. Without building such a powerful corporation that could compete in the fierce international market, their economic growth would have been a much more slow and steady burn, as without a monopoly and government sponsorship, the private sector would have struggled to gain foreign investors and negotiate lucrative agreements. Their historic economic boom, that is now called the Miracle on the Han River and the Taiwan Miracle, can be largely attributed to the modernization and government sponsorship of few selected firms. However, this amount of power from a key select few over the entire country has caused many issues in both countries, and this is especially prominent in South Korea. Many of the top executives from Samsung, Hyundai, Lotte, and SK have all been found guilty of corruption, tax evasion, bribery, embezzlement, and other crimes. Chaebol's lobbying for favorable treatment has become a normal practice, and given that these 5 companies represent half of the Korean stock market value, presidential pardons and reduced sentences were handed out to all chaebols and their corporate executives. This became such a common practice that in the Korean judicial system, it has been nicknamed the chaebol negotiation rule, where a 3-year prison sentence usually gets reduced to a simple 5-year probation for chaebol-related personnel. Although Korea's chaebol system brought confidence to Korean investments and fostered an economic miracle that rewrote the history books, the very system that brought success to Korea also brought tons of structural, social, and political issues that Korea still faces to this day. It is just that today, they get to struggle while having the largest and most profitable companies and economy in the world, rather than the poverty and starvation it had before. Many could argue that these profits were only seen by a very select few. This is also true and could be morally wrong. My thesis does not refute those points, but to only investigate the economic perspective of the government-sponsored monopolies.